Good morning, everyone. Andy here with TradingAdventures.com with your look at the weekly charts, which are going to be a little different this week after yesterday's action. Last week, the theme was continued strength, and the markets had been drifting higher very steadily for many weeks in a row. Then Wednesday, in my midweek market review, we were focused on a short term shift in character that was based upon a couple of things, which we'll get into, namely the roadmap and the lower lows and lower highs below the 5 day moving averages. And then Friday, we got a very sharp decline. So we're going to dig a little deeper this week and go through some of the messages and signals that the market was potentially sending ahead of the decline Friday, just as a way to demonstrate, revisit, and learn or reinforce some of the practices, some of the purposes of technical analysis, and some of the tools we use that helped be prepared and on the right side of the action during that decline. So it's about recognizing when the evidence begins to change, and because the market is always sending messages, and our job simply is to listen. So moving right into the charts, starting here with SPYs, we can see the big red candle here that came down from very near the upper Bollinger Band, and it's still well above a rising 10-week and 40-week moving average. So there's no real big destruction or damage to the technical picture of the market, but it was a solid decline that, let's see, from the high to the low here, it's about 3.5% there. On the week, and we can see yesterday's action. The market was down 2.5%. Most of this selling came yesterday. We'll look at the daily picture of the Qs here in a minute, which were down nearly 5% on the day. And again, the overall picture of the market is we're still very firmly in an uptrend, but this is something to note. It's a change in the action. We haven't seen this, and so what we want to be watching for from here, of course, is does this get worse and signal something more lasting, or is this simply a natural reaction with some profit taking and some lightening of positions after what has been a monumental run? And one of the things that I pointed out, and I shared this on X the other day, this chart originally was shared in my article with the CMT Association's Market Mosaic Daily. I'm going to send this recap to all of you in your email. I posted it on X yesterday, but the demonstration was pretty much this. The RSI was the indicator of focus here. And on May 7th, what I wrote was it's not about the RSI. It's not about the market being extended. It's about what happens after that. And I highlighted that the signal we want to be on the lookout for here is new highs in price action without a corresponding high in the RSI, which is once it gets up here to the 82 level, it's very hard for the relative strength index to keep pushing higher and higher. And that's exactly what we saw happen here. And with this new closing high on June the 2nd, we saw several instances here which were some subtle alarm bells that maybe things are shifting below the surface here. And we saw many of those across the market. So we're going to look into some more of those so you can see what happened and know what to look for in the future. Back to the weekly charts here. I will point out volume was up pretty substantially over last week across the board. However, for the major market indices, it's still not even back to the 20-period rolling average there. So while we did see a rise in volume, it's nothing astronomical. The Dow held up the best. We've got a bit of an ugly candle here. This is a potential topping candle. Maybe you could call it a doji or some kind of pattern, which is really not important. The price action is what we want to focus on here. It went up, made a new high, and couldn't close there. Is that alarming? Perhaps. Is it a signal by itself? No. It is one part of the message that the market is sending, because you look at the overall price action of DIA, it's still incredibly strong in an uptrend from this bottom back in March and above all the rising moving averages. Russell 2000, the IWM, similar. This was a potential reversal pattern candle last week that got confirmed this week, and now we know the reversal has happened. It gapped up, touched this extension level, and then opened below that and continued lower for most of the week, closing down near the lows. It's below a rising 4-week moving average, but still well above the 10-week average, the red line here. It's well above this anchor off of the recent lows, which I've drawn on most of these charts, and very far above the rising 40-week moving average. So looking back at some of the clues that appeared before the sell-off on Friday, we've been covering Bitcoin extensively, and the action started off of this test from the VWAP anchored to the all-time highs, and we saw price action deteriorating slowly at first, and then this week Bitcoin crashed nearly 20% in one weekly session. Volume is more than double last week. It's above the average here, and we pierced this low from February 2nd. And the reason that was important is because Bitcoin and the more speculative asset classes are often a gauge of temperament or sentiment with the very speculative parts of the market. And so this was a signal all along that the appetite for risk, especially in cryptocurrency, was cooling off. And again, I can't stress this enough. None of these things by themselves are predictive, and even in concert as a group, they're not especially predictive. It's just the message that the market is sending. It is the puzzle that we put together piece by piece, week in and week out, to try to get a feel and a gauge on what we're being told. Moving into the dollar, we saw a strong rally this week. This is the level that we've been watching, or the range, I should say, that we've been watching for quite some time. It was support a few times. It's been resistance many times. And now the US dollar futures index is back up into this shaded area. It's testing this VWAP anchored from the highs, and quite a strong rally here. We'll have to see what comes next. Is this resistance again? Can we go on and rise over this range, or does it turn around and come back down into this wider, choppier range that it's been developing for quite a number of months here? Volatility up strongly this week. Again, most of that action coming on Friday. This is actually almost all of that action coming on Friday. As the market sold off, uncertainty was rising, and the volatility index, VIX, was corresponding to that. All Cap World Index, this is, I call this the rest of the world. This is without the US, ACWIXUS, and another reversal pattern here. Last week's candle was a breakout, but it signaled indecision with the open very close to the close. Couldn't really find a lot of direction, and this week that is confirmed with a trip back down below these recent highs, below the rising 4-week moving average, and not quite to the rising 10-week. So once again, the uptrend is still very much intact at this point. It's just some profit taking and corrective action off of these recent highs. China still looking pretty susceptible here, but it didn't break through this level and crash. And if there was a market environment for that to happen, Friday was probably pretty ripe for that. So maybe some encouraging, slightly encouraging action here in that China held this low, the FXI held this area, but certainly remains to be determined. We'll have to see how it behaves next week. Bonds, more consolidating action that is moving lower. It's, again, not breaking down, but just trending and chopping lower below all the moving averages. That was the AGG. Here's the TLT bonds, which actually they weren't down as sharply, and they're above a declining 4-week moving average, but still in this overall choppy downtrend there on bonds. And the high yield sector, which trades more like stocks, was down a little sharper, but still not testing these recent lows. Commodities as a group, we're going to skip that and go straight into oil. Oil had a bit of a wide range here for the week, but still in this choppy consolidation as it tries to find its way. Gold is the one that's flashing some more warning signals here. A very strong downward action here, opened near this level and moved lower all week long and is now below. This is the first weekly close below a 40-week moving average in quite some time. I don't know how far. Let's see. This was all the way back in October of 2023 when it was really below the 40-week moving average there. It's below this recent high back in October of last year. And so this could potentially open up significant more downside pressure for gold, as silver is still above the 40-week and testing and holding that so far on Friday and to close out the week. But those are a couple areas if you're involved in gold or you're interested in what happens in the precious metals there, gold and silver, that's something you want to be paying close attention to. Now I want to break from the usual path a little bit and look at some of the really strong recent leaders in this market, some of the more speculative spaces that have been holding up and leading things pretty well. I should start with another one first. Uranium, not especially strong, but holding this area, trying to maintain support above a 40-week moving average and a large range this week that takes it down below that moving average once again and testing these recent lows. Quantum names, which were enjoying some strength and increased volume for several weeks, is quite a run up here as this has been a leader on this rise. Once again, not broken, still in an uptrend above a rising 4-week moving average, but it's a big range up here. This is roughly 10% from peak to trough there on the weekly candle, and so it's something to be mindful of. Do we see continued pressure? Do we see follow through to the downside? It has a long way to go before it would even threaten a reversal in trend, but it is something we want to pay attention to. AIQ is an ETF focused on the artificial intelligence sector, and it's a big outside candle here, or a bearish engulfing if you want to call it that. Closed below the 4-week moving average, still in a very strong uptrend up to this point. We do have a lot of volume there. And again, the thing we want to be watching for from here is their continuation on down into this range and eventually into the other rising moving averages. Semiconductor index, once again, and this is not the levered version. If we were looking at SOXL, that might be a little more expected, but a 13% range from the highs to the lows in the semiconductor is quite a move. It's not especially out of the ordinary. We've seen many very big upward candles providing ranges near that, but this is the first one we've seen move lower consistently and close on those lows in quite some time. And once again, it's right at the rising 4-week. It's still in a very strong uptrend here. So there's a good possibility that this is just some normal profit taking, some normal lightening of positions after a tremendous run in what have been the strongest leading sectors. And now, okay, this is a blockchain technology ETF. I could show you ABIT, but that's just Bitcoin, and we've already looked at that. So this is more of the names that are involved and related in the blockchain sector. And it's a strong reversal, taking back all of the progress made over the last 4 weeks. But notice here we have the slightly rising 40-week, the strongly rising 10-week, and the anchored VWAPs from both the recent high and the recent low here. So there's a case to be made, not to mention the price action from these bars, all in that area around $60 a share. So there is a case to be made here for some pretty strong support could show up in this area. We'll just draw a little reference point in there and see how that behaves next week. That is the blockchain crypto ecosystem there. And so these aren't random sectors. These represent some of the market's favorite growth and speculation themes. And the takeaway here is that when traders become less willing to pay increasingly higher prices for the leadership themes, it's just information worth respecting. It's something we want to pay attention to. Risk appetite often weakens before the overall indices do, and we've noted that in a couple of different ways. We continue to see that idea or that piece of information show up in a couple of different formats. So while we're on individual sectors here, we'll go ahead and look at the biotechs and some of the others before I go back to the relative strength relationships. XBI had a chance to break out here. We noted that last week. It was back above this level and looking a little better, and now it's back down to this area, which has been pivotal in the past. It's not broken, it's not damaged, it's still in a bullish consolidation in an uptrend, but it is below the 4-week and the 10-week. It's right here at the middle of the Bollinger Bands and back through all of this price action that we've seen be such a magnet for many, many weeks now. So it is a more critical area, I think, if biotech is going to have a shot at going on to make new highs. I think it needs to hold this area and resume upward action pretty quickly, but that could also take place in the form of a bit of a flush down below and shake out some of the weaker hands before it comes back up. RSI still in the bullish upper half, and again, nothing broken there yet, just action to be mindful of. The software sector did have a pretty large reversal here, but again, I'm sounding like a broken record now, but the theme is so similar across all of these recent leaders. It's just been a tremendous run. So despite the giant red candle here, which is, I think that was 10 or 11% I just measured there, it's still up here near the upper Bollinger Band, even though those are sloping downward and starting to pinch just slightly from this very wide range. It's still holding up above a rising 4-week moving average. It is back below the declining 40-week, and so that's something we got to pay attention to. But it doesn't predict what's going to happen next week. We need to see it hold in this area and then get some stability, and then maybe the bands start to curve upward as these shorter term moving averages catch up. We'll see how that behaves. Financials, one of the things we noted last week was the potential or the addition to the bullish case that would happen if financials were to break this consolidation and join the party. They have not done that so far, and in fact, they almost looked like a potential failed breakdown here. The prices were lower early in the week. Let's just look at a daily chart here quickly. We had a bit of a breakdown attempt here on Wednesday that was quickly negated with a large gap up on Thursday's action, and Friday, while the rest of the market was selling off, financials were holding up here very well. They're not out of the woods yet. They have not broken out yet. They're still below a declining 40-week moving average, but it is a step in the right direction. So that's something we want to pay close attention to next week as well. And then XLE, the energy sector, trading very similar to oil, just chopping and consolidating here in the middle of this range. This is a 20-period moving average right in the center of the Bollinger Bands here. The bands are tightening. RSI is still in the bullish upper half. And while we're here, we might as well go ahead and look at technology. Looks very similar to the Qs, no surprise there. And the communications sector breaking down a bit on the moving averages, or from the moving averages, I should say, on the XLC, which is the communications sector. So backing up a bit here and looking at some of our relative strength relationships as a measure of risk appetite. First, individually, here's the Russell 1000 growth portion of the market. Here's the value portion of the market. Here are the consumer discretionary stocks, and here are the consumer staple stocks. And so you note all that price action, and now look at them relative to one another. No surprise there, growth versus value lost a step, or in other words, value was the stronger area this week as we see a big reversal candle here. Discretionaries versus staples, strong shift toward the favor of staples. I think I went through this a bit last week, noting that the reason we watch this is when the discretionary stocks get weaker relative to the staples, that indicates that perhaps market participants are focused more on the products and the needs that they have to have versus the ones that they want to have. And so this is, again, not broken, not an overall change here, but a shift in 1 week that we have to pay attention to. If we start to see the staples pick up continued, and persistent strength versus the discretionary, that's the signal we're looking for. Another potential defensive sector is healthcare stocks, which had a very strong rise this week. Utilities, and I haven't looked at these charts yet. Utilities still kind of breaking down there. So what is perceived as a more defensive area of the market, not participating to the upside there. So a bit of a mixed bag on those messages. High beta versus low volatility. No surprise here to see a shift back towards low volatility in that relative strength relationship. Now we shift over and look at breadth and participation a bit. And this is actually pretty interesting to me in a week where the market leaders and overall market indices sold off sharply towards the end of the action. We actually see a slight uptick here in the number of stocks above a 50 and 200 day moving average in the S&P 500. So that still holds up very well. It's above the middle of the range and increasing for the week. So that's somewhat encouraging as far as a breadth measure. And now let's take a look at our bullish percent indices. And right in the middle of the range still here. The bullish percents on the S&P 500 still in bull confirmed status. We still have a column of X's, although the calculation is down here and nearly reversed into a column of O's. We'll have to see how that progresses next week, but so far holding up just fine there in the middle of the range. The NASDAQ index bullish percent did give us a column of O's, and a pretty strong one at that. It's down here near what is called the bullish support line. Not broken. It is bear confirmed status, as it gave a sell signal here with this column of O's exceeding the previous column of O's, but the calculation rests at 47. It's still very near the middle of the range here and may set up better for a rally if that continues but holds support. And then finally, the NYSE bullish percent, same story here. It's holding up in the middle of the range. It is in a bear correction status, but that just means that we have not put in a new point and figure buy signal recently with the column of X's exceeding the previous column of X's after this sell signal back here. So much like the percentage of S&P 500 stocks relative to their 50 and 200 day moving averages, the bullish percent indices are holding up here in the middle of the range. So no big red flags or alarm bells sounding there. So back to our normal weekly charts here. I think we already looked at the Mag 7. If not a reversal here, the 4-week moving average is flat, but we're still above a rising 10-week and 40-week, still above the anchor off of this recent lows. And it is a sell-off for sure, but not broken yet. Maybe in weeks to come we can accurately describe this as a failed breakout attempt, but I wouldn't call it that just yet. Looking at some names in the Mag 7, Apple still the leader, still holding up very strong, still above a rising 4-week moving average, as opposed to Amazon, which is now back down below this extension level, below a sharply rising 10-week moving average, and may want to test this area here around the 240s, or even potentially down to the 40-week moving average, which is down here. Google still holds up pretty well, and this, despite the sell-off, a bit of a gap down and a test of the, or nearly a test of the rising 10-week, this is still fairly orderly consolidation here after such a strong rise. So still potential for reversal back higher there on Google. Meta, on the other hand, is still just stuck. It's the declining 40-week moving average up here. This trend line has provided supply or resistance several times. Couldn't even get back to that level on this recent rise, and it's below all the moving averages and looking susceptible there. Microsoft, which looks much like the IGV, the whole software sector, again, it's a bit alarming here as it attempted to get above the 40-week moving average and then really failed pretty hard all the way back down into this area. It is still above a rising 10-week. It's above this anchored VWAP from the lows, and so not completely broken yet, but big red reversal candles like this certainly are cautionary. NVIDIA, just not going anywhere, which is fine. That's not necessarily a bad thing. And again, maybe in the weeks to come, we could label this a failed breakout attempt, but so far I would be hesitant to call it that. It's still above the 10-week moving average. It's still above the VWAP anchored from the lows, and still in the upper half of the Bollinger Bands and close to these highs from back in October of last year. So it's certainly not broken. It's just some corrective action, some consolidation up here. in the upper Bollinger Bands after what has been a pretty strong rise there. And then lastly, Tesla still without a directional resolution. It came up, it's come back down, it's right in the middle of the bands, which are slightly declining, and RSI bouncing around here, right around the midpoint. So a lot riding on the SpaceX IPO, which is set to price in the market on Friday. A lot of speculation and differing opinions about how that will or will not affect Tesla's stock. There's even discussions of a potential merger of the companies. All of that is speculation at this point. We just have to wait and see what happens. Can it hold? What we want to see from a price action standpoint is, can it hold this range and start to rebuild higher, or does it continue lower and the boundaries are still down below this recent low, which was around 337, and this high of about 498. So it's quite a large range there. This is a logarithmic chart. If we change that to an arithmetic chart, you can see that looks a little more in line with the recent price action, and 150 points there on a $400 stock. It's not out of character for Tesla, but it is a wide range that still has yet to be resolved. So tying it all together, this week is a useful reminder that the sell-offs do happen. Profit taking does happen. We've been a bit spoiled as of late with just a continued steady rise up and up and up, more every week. And as they say, the market rarely rings a bell at the top or before these sell-offs occur, and I'm certainly not willing to call this the top or even a top yet. This is just one weekly bar after a very, very strong rise. We're still very high up in the range of this move, and it's just something we have to pay attention to. And so as the market rarely rings a bell, it's the things we have to look for continue to be the same. Conditions usually change gradually. Momentum stops confirming, which we saw on the Qs with the RSI. I'm sure we could find other examples. Leadership narrows, which we see perhaps happening a little bit now. And from a practical application standpoint, those of you in Alpha Trends know that we've seen this happen in real time with our check, which we do several times a day, of the overall markets. It started on Wednesday, and in my article even shared here with you about the changing or slight shift in character. And the reason for that was because we started seeing lower lows and lower highs below a 5-day moving average, which is now declining. Here's the F version of the chart. Lower lows, lower highs below a now declining 5-day moving average. Those are the signals we watch for on the way. And another piece of corroborating evidence that came up, and again, those of you in Alpha Trends heard it from both Brian and myself, we simply had fewer attractive setups for long swing trade entries. We didn't design it that way. We didn't choose for it to be that way. But as we go through the process and look at or look for potential trade ideas, there was just less presenting. There were fewer options to choose from. And so that is a signal that the price action is evolving there. It's perhaps the risk appetite is beginning to fade. We don't see as many things following through or setting up for those good low risk entries that we look for. So by themselves, individually, none of those observations are decisive. It's the picture that they paint together is what tells us what to be on the lookout for. So our job is never to predict. Our job is to evaluate the evidence and adjust our level of aggressiveness based on the message of the market. The market is always sending those messages, and our job is simply to listen. So as always, follow the price, respect the structure, manage your risk, and let the market tell you what's coming next. That's how we win this game. That's how we stay in line and participate in the proper fashion. So have a great week. I hope you guys find some useful information in these weekly chart rundowns. I'll keep the updates coming, and I will share the recap of the Q action that I promised probably tomorrow. So keep an eye on your inboxes for that, and we'll talk to you again soon.